When you buy a traditional asset, you are often participating in a market shaped by a labyrinth of brokers, institutional market makers, and hidden fees. These layers create a buffer that obscures the true value of your investment. TradePesa removes these intermediaries entirely. It functions as a transparent digital marketplace where users mint and trade their own tokenized items using a unified platform currency. This diagram shows the mechanics of that ecosystem. Because no corporate entity sets the price or manages the spread, the economy operates in a vacuum. Every price movement is tethered exclusively to these two data points, total buy volume and total sell volume. It is a market of pure supply and demand. In an environment this reactive, your strategy has to change. The way you execute a trade impacts the market just as heavily as the item you are trading. A common mistake is assuming that a massive buy order represents absolute power. In a transparent, frictionless market, that brute force often triggers a mathematical penalty that can drain your capital instantly. When the middlemen are gone, the weight of your own capital becomes a variable. Success requires managing that weight against the physics of the environment itself. To understand the physics here, start with the baseline law of the marketplace. Every buy transaction forces the asset price up, and every sell forces it down. Consider a chronological sequence. Trader A buys a token, causing an immediate upward shift in the asset's price. Because they paid a premium over the starting price to complete the order, Trader A is actually sitting at a slight initial deficit. Trader B enters the market immediately afterward and buys the same token. This second surge of demand forces the price even higher, starting from the new, elevated floor created by the first trade. Only now does Trader A reach the break-even point. They required the volume of Trader B's subsequent buy to offset the cost of their own initial entry. Trader B, however, is now in the red. By buying into the momentum Trader A created, they were forced to pay the inflated price manufactured by the preceding trade. In this sequence, your immediate profit is dictated by the volume of community action that occurs after your trade executes. If we move past the timing and look at volume, we see how the market equilibrium reacts when opposing trades are vastly different in size. Imagine a whale with massive capital, Trader A, and a small fish with minimal capital, Trader B. Both are engaging with the same token at the same time. Trader A executes an aggressive buy of 1,000 units. This massive volume instantly shifts the centralized price ticker from 1.00 up to 1.04. Because this order was so large, it consumed all the cheap available supply. Trader A was forced to pay higher and higher prices as the order filled, pushing their average cost per unit far above the initial market price. Trader B enters right after the whale and executes a small short sell of only 500 units. This small volume causes the price to drop slightly, settling at 1.02. This creates a major deficit for the whale. Because Trader A's massive order skewed their average buy-in so high, this minor downward correction from the small fish leaves Trader A down by $60. The small fish, however, breaks even. Their 500-unit trade at the 1.04 peak didn't have enough weight to crash the market, allowing them to remain neutral despite the price shift. Injecting massive volume into a pure market acts as a structural penalty, placing the financial burden of rapid price movement squarely on the heavy hitters. You do not need massive amounts of capital to win in an ecosystem governed by raw supply and demand. Because the platform is 100% transparent, smaller traders can monitor the balance of buying and selling in real time, looking for the footprints of larger players. This is the strategy of riding the wave. You wait for a larger player to incur the structural cost of moving the market, then you jump in to capture the resulting momentum. You can practice identifying these volume asymmetries and testing your timing without any financial risk by using TradePesa's demo mode. Sustaining a portfolio on TradePesa comes down to mastering the physics of market weight, identifying the ripples created by the community, and moving before they settle.